So now we should have a very solid understanding of market structure and how we essentially use market structure as a mechanical framework to guide us through the order flow of the market. But now we are ready to start to look at the actual mechanics of the market, as in what is actually behind the production and the interaction of that order flow that then generates the market structure that we have just been spending time analysing. Now, as history has repeatedly shown, speculators as an aggregate, they are often a very, very emotionally charged group. Now, when you get millions of them together in a highly emotional money game of fear, greed, and uncertainty, their combined behaviour kind of takes on a kind of herd mentality. So technical analysis is the framework that we use to identify trading opportunities through the study of price movement and volume from that battle between buyers and sellers that is then reflected on a price chart. So you have big commercial companies, putting huge orders through the market. So say if a Japanese construction company, maybe they need to buy thousands of tons of timber from Canada, for example, then they're going to need to exchange a large amount of Japanese yen for Canadian dollars in order to make that purchase. So they approach the dealing desks at large banks to facilitate that transaction on their behalf. So BFIs, banks and financial institutions, those are the other big players who are putting massive orders through the market for various reasons. Then we also have speculators who are purely trading to try and extract a profit from the movement in exchange rates, right? And this also includes large financial institutions as well as independent retail traders such as us. Now that is, of course, not an exhaustive list of market participants, just kind of some of the main ones that we can think about. Now, all of those are affected by the forces of human emotion that come into play when sums of money are involved. And all of this behaviour and participation is what drives the order flow that is put through the market. So that interaction of buyers and sellers with that order flow then prints the price action that we actually see on our charts. And that price action then creates patterns. And it's these patterns that repeat themselves over and over, time and time again. Crowd psychology has been reflected in the prices of stocks, indices, commodities, futures, and currencies since the beginning of the free market. And that interaction of millions of different participants for as many reasons, all with their own emotions and agendas, that forms price patterns that stretch over extended periods of time and can be used to make high probability forecasts of where price may potentially move in the future. Now, currency exchange rates, they move up and down as a result of supply and demand from market speculators. So every day, investors and traders, both institutional and private individuals, all buy and sell currencies. And the numerous types of market participants that we just discussed, they are buying or selling for their own unique reasons, with their own unique views, ideas and beliefs around what the currency pairs they are trading are actually worth. Now, the meeting point of those buyers and sellers, for whatever reason that they are acting, is price. So no trades can take place unless both the buyer and the seller actually agree on a price. So this drives the price of currency pairs, with buyers bringing with them demand for the pair, applying that upward pressure on prices, while sellers bring supply, applying downward pressure on prices. And the market runs like a continuous auction throughout the day, with buyers and sellers constantly competing with each other to get the best possible price. Now, in a perfect kind of free market, this would be a pretty smooth and fair process. However, in the financial markets, this can often be quite a heavily manipulated process. So let me explain. First, we need to have a quick and very, very basic lesson on Economics 101. So on this diagram, on the y-axis, on the left-hand side, we have the price level for the cost of product X, right? And then down along the bottom, on the x-axis, we have the quantity of product X that is available to buy from sellers of product X. So now what we do is we plot on this line here, and this line represents the demand from people for the product. So obviously at the start of the curve, where price is at its highest, the amount of quantity demanded for product X will be near its lowest, because not everyone really wants to pay or maybe can afford such an expensive price for product X. But as the price falls, the demand for it will increase and increase and increase. More people will want to buy or will be able to buy the product as it gets cheaper. That makes logical sense, right? Of course, there are some exceptions, like designer clothes, for example, where more people actually desire them, the more expensive that they are. But generally, when something is cheaper, more people want and demand it. So at the lower price, P2, more quantity of the product is demanded at Q2. So demand increases as the price falls. Now, let's just remove the demand curve for a second and we'll bring it back in a minute. So this line here represents the supply of product X. So down at the start of the curve, on the bottom left-hand corner, where price is at its lowest, the amount of quantity that is supplied to the market for it will be at its lowest. But as the price rises, the supply of the product will increase and increase and increase because suppliers, so sellers of the product, they will then be more heavily incentivized to supply and sell the product because they're going to receive more money, right, in exchange for actually supplying it. So hopefully this also makes logical sense, because the higher the price that you can get for selling something, generally the more of it you're going to want to sell, or more people will then enter into the market and they will also start to sell it. So the total supply of product X will increase at the higher the price is. So supply increases as the price rises. But we can't just only have sellers in the market, and we can't just only have buyers in the market. We need both a buyer who demands the product and a seller who supplies the product, because it takes two to make a market. So when you plot both the demand curve and you plot both the supply curve over each other, you can then see where the market price will be. So where buyers and sellers meet is where they agree to exchange money for their goods or service, and that determines the market price. So that price where the supply meets demand, that is the fair market value. But what happens if there is a lot of demand for a product? What if there is so much demand that the product completely sells out and there are no more sellers left at that price level, but people are still demanding it? People still want to buy it, but there's no one there to sell it to them. Well, the price is going to increase, right? Because there needs to be an incentive for new suppliers to enter the market to fulfill that increase in demand. Or people, who still have the product left to sell, they're simply just going to increase their prices because they know that they can get away with charging a higher price, right? Because there is so much demand that people will be willing to potentially pay a higher price. So what happens is the demand curve shifts up like this. So now the price goes up in order to increase the supply of the product to meet that increase in demand for it. So if everyone wants to buy a product, but nobody wants to sell it at the price P1, then the only way to either fulfill or reduce the demand is to increase the price to P2. So then you'll get the increase in the quantity supplied from Q1 to Q2. So if the price goes up, then the amount of supply will go up, and the market reaches a new higher equilibrium price from that increase in demand. And this is the new fair market value. So the exchange rate in the Forex market, it works by the exact same principle. Now, this mechanism is going on continuously every single second that the market is open, and price is constantly moving pip by pip to match the price perfectly between the demand and supply, between both buyers and sellers. And that is how a free market works. Now, the more liquid a market is, the easier that price can slowly, move slowly and smoothly up and down. But when there is an overwhelming imbalance between the supply and demand, so when there is a lot more quantity demanded than there are actually sellers supplying it, or maybe a lot more sellers supplying the product than there are actually people willing to buy it at the current market price, then there is an aggressive change in the price level, because either the supply or the demand, right, it has to shift a significant amount to find the new market equilibrium price. So in an ideal situation, if markets were absolutely perfect, this would be quite a natural process where buyers and sellers can freely agree on price. However, in the financial markets, this movement of price is often quite a manipulative process. So the big players that we mentioned earlier, the banks, the hedge funds, and any sort of large institution, they have the ability to control movements of price to a degree due to the huge amounts of volume that they put out into the market. Using all sorts of tactics to trick traders into potentially taking the other side of their positions in order to utilize them for liquidity. Now, being able to recognize this is going to bring you one step closer to joining them. Because what if I told you that on the price charts, they actually leave footprints and clues indicating their manipulative actions? See, these institutions, they just have no way to actually hide the overwhelming imbalance in the supply demand that they create to cause price to move in their favor, because their order flow is just so large. because when they put their orders through, it creates those huge shifts and imbalances in the supply and demand in the market. Now, every time frame shows the same patterns again and again, where you can literally see where this is happening. So using all of the time frames together, it's going to provide a clear picture on where the big players are entering and exiting the markets, so that we can time our entries and exit with extreme precision using a mechanical edge. But before we look at how we can see these imbalances being caused between supply and demand by those big players on our price charts, first we must understand a little bit more about the mechanics behind that order flow in the market. So order flow is the interplay between both passive and aggressive orders in the market. In more simple terms, it essentially just means the interaction between buyers and sellers, so the supply and demand that they bring into the market via their orders, right, that they are putting through the market. Now, a passive order is an order in which the price is different from the current market bid and ask price. So this is typically limit and stop orders, so orders which are waiting for price to either come up or come down to them to hit them. So kind of a really simple way to think about this is passive orders are essentially just pending orders sitting in the order book, waiting to be filled when price eventually reaches them. So remember, a limit order is one where you buy or sell at a specified price or better, below or above the current market price. Now, the other type of passive order is called a stop order, and a stop order is where you buy or sell at a specified price or worse, above or below the current market price. Now, if you haven't done so already, please watch the module on brokers where we discuss the different order types in much more depth. So both of those stop and limit orders are classified as passive orders. So essentially they're just pending orders that are sitting in the order book waiting to be hit, right? But the other type of order is called an aggressive order. And aggressive orders are when a trader executes the order instantly so that they buy or sell at the current best market ask or bid price. So it's generally an at market order. So if you just want to instantly buy an instrument, right, you will get filled at the best current ask price. And if you instantly want to sell an instrument, then you will get filled at the best current bid price. So order flow as a whole, it is essentially just the interaction, so the interplay between all of these types of orders. So you have the passive orders, those pending orders that are just sitting there in the order book waiting to be hit. And then these passive orders are actually visible in the order book. You can see them, just sitting there. But then you have the aggressive orders where traders just step in and instantly hit either the current best bid or ask price. So what does that actually look like? Well, something that is commonly used in the markets, which trade through a central exchange, such as the futures market and most stock markets, is a price ladder, which essentially visualizes the order book. So it's otherwise known as the DOM, or the depth of market. And it shows all of the bids and offers, those passive orders that are sitting in the market, those limit and stop orders, and it shows the amount of volume, so the amount of supply and demand that is sitting at each individual price level. So on the left-hand side, you have the bids, so the amount of demand that is willing to buy at each price level. And then you have the offers on the right-hand side, so commonly referred to as the ask prices, which shows the amount of supply at each price level. So the top green level is the current best market bid, and the bottom red level is the current best market ask. And the blue price in the middle, that represents that last price level that was traded at. So in this case, the last trade that was executed was someone buying at the ask price of 1.1530. Because remember, you have to buy at the ask on the right and you sell on the bid price on the left. So if you want to sell, then you have to sell to the highest bidder. And if you want to buy, then you can buy from whoever is asking for the lowest price for the product, right? Now, when you go and look at your own Forex broker, what you will see is just the current best bid and the current best ask. And then the difference between those two prices is the spread, right? So in this case, the spread would be 1.1530 minus 1.1529, which essentially means a spread of 1 pip. So if you wanted to instantly buy the instrument, that would be an aggressive order, and you would buy at the current best ask price, meaning you would hit that passive order at 1.1530 and you pay the spread of 1 pip. So let's take a look at a very, very oversimplified, theoretical example of what can happen on the order book in the live market. So imagine that this was the order book for euro dollar. Now let's say that a company over in America They want to buy an innovative tech company that is doing really, really well in Europe. Now, that American company is going to need euros in order to buy that European company, right? So they will call up their bank's dealing desk and they will say that, let's say they need to buy 20,000 lots of euro dollar because they're going to need to sell their US dollars to buy euros, right? And they tell the bank's dealing desk that they need this transaction completed within 48 hours. And please get us the best possible price. Now, the bank's traders, sitting on that dealing desk, they may not want to put through all of those 20,000 lots all in one go because there may not be enough liquidity to fill that huge order without experiencing massive slippage. Because if we look at this current example, if you look on the right hand side, we can see the amount of supply that is sitting there on all of those different ask prices. Now, if the bank was to instantly buy at market with those 20,000 lots, price will absorb all of the supply on the right hand side. That huge demand that the bank would be entering into the market is going to eat up all of that supply, and price will just keep going up and up and up until every single one of those 20,000 lots have been filled. If they were to enter that with an aggressive order, so an at-market order. So what they may do instead is split up the order into smaller parts to hedge the risk of experiencing that negative slippage and see if they can average out a better price for their client. So let's keep it simple, and let's just say that they enter half of the position now. So they press buy on 10,000 lots for an at-market execution, so they hit the best current ask price. And what will happen is the 10,000 total lots sitting on those ask prices will instantly get absorbed, and the price will shoot straight up to 1.1539 due to that huge imbalance between supply and demand, right? Because there was an overwhelming amount of demand at that current market level. So what did price have to do? Price had to rapidly shoot up in order to fulfill that huge shift in demand until there was enough supply at a higher price level to balance price back out, to balance both supply and demand. And now the market is sitting at what is deemed to be fair value between buyers and sellers. So half of their order has now been filled, but the bank doesn't want to keep chasing the market higher and higher and get filled at an even worse price for their remaining volume, right, for those remaining 10,000 lots. So what they do is they leave the remaining 10,000 lots as a passive order, so as a buy limit order, back down around that original price level of 1.1529, as this is where they hope that the market will eventually trade back down to fill them within the next 48 hours for their client. Now, if price eventually gets back down to that level of 1.1529, what do you think are the odds that there will be more supply than demand to absorb all of that demand of that huge buy order of 10,000 lots, and the rest, right, to keep pushing price down past that level, to keep pushing price down past 1.1529? I would say the probability is that price is more likely to see a bullish move from that price level, or at the very minimum, there will be a bullish bounce, right? There'll be a bit of a reaction as the market experiences that imbalance between supply and demand at that level. So essentially what this does is it gives you a really great edge to look to be buying around that level, right, with this huge demand, and then surf on the coattails of that order flow, right, of the order flow of the whales, of those large institutions in the market. Now, because the spot forex market is an OTC market, which means it's traded over the counter, this means it is a decentralized market. So there isn't one central exchange where all of the total volume and all of the total trading activity goes through. So you can't really look at an order book of just one liquidity provider and get a super accurate view of what the true total order book looks like for the entire forex market as a whole. But we don't need to. And also in reality, reading a price ladder can be very, very complicated, as all of this buying and selling activity, so the interaction between supply and demand, is extremely dynamic, especially when you throw in the aggressive orders that are hitting the bids and the asks that are sitting there. So it can be very hard to read. So instead, what we use is a price chart. And a price chart gives us tons of information on the current and the past prices that have been traded, and in the chronological order in which those levels were traded. So essentially, we just see that middle column here of how price moved up and down those levels, but also how quickly price moved up and down those levels. And that's where multi-time frame analysis comes into play. And that's why we use candlestick charts, because they give us a lot of information, but you just need to know how to be able to read it effectively. So with this example on this order book here of what we just went through, how could that example possibly look like on a price chart? Well, how we may potentially see, something similar to that in the order book theory that we just looked at. Obviously, a very sort of, oversimplified theory of how it really goes on in the market, where we have, millions of different participants. But generally, you'll see price kind of chopping around, sort of, ranging sideways, moving up and down, not really going anywhere with real conviction, right? Just some even distribution between buyers and sellers, and then boom, what happens? We get that overwhelming imbalance between supply and demand, right? Where demand has clearly overpowered supply, and we have initiated out of that range and broken to the upside, right? So imagine, 10,000 orders just being filled and pushes price all the way up to the upside to try and find as much supply in order to fill all of those lots that the bank, firm, or institution wants to buy. So price then shoots up to the upside. But it's very likely that there's still going to be a lot of sitting demand back within those initial price levels of where there'll be orders and liquidity that price wants to then fill. So what we'll very often see is then price start to make its way back down towards that level, pick up those orders, and then boom, you'll see another imbalance between that supply and demand again as those remaining orders are filled and demand is now fully in control. And yeah, we just see the same thing happen again and again and again, right? If you just go and look on any single price chart and you just scroll back, right, you'll just see the exact same thing happen again, where you have price ranging, price initiates out as we get that imbalance between supply and demand, price comes back into that demand and it fills the next orders, right? We get that range, price initiates out, price comes back in to fill those orders, right? We get a range, price then initiates out, right? The origin of that move, price comes in to fill more orders, and then we move away, right? We initiate out that range, price comes back in to fill those orders where the demand stepped in, and we initiate out that range, right? We come here, break up those highs, price comes back in to fill the remaining demand, right? It just happens again and again and again, right? Price range in, we initiate out, price comes back in to fill those orders, right? Same thing, original range down here, right? That was the origin of the move. Price comes in a little bit lower to fill those orders, right? It needed more demand to then continue that move. And the same thing will just continue to happen, right? We just get rid of all of that price action and play it forward a bit. It's on every single time frame, right? Time doesn't know price, price doesn't know time. It's just orders going through the market that we can then see on those candles, right? As price continues to move up, right? It pulls back, it ranges, demand steps in again to take control, boom, right? Pull back into demand to then continue to fuel the move, right? Then we have this range here, demand steps in, price comes back in to fill those remaining orders, and then we come off, right? Demand steps in, price comes back into that demand to then make another move here, right? Again and again and again. So obviously we'll cover this in a lot more depth in the charts in a bit, but now you can kind of just see how a simple example like that actually is translated onto the candles on the charts. So if you're a little bit confused potentially about some of the things that we just discussed in this lesson, don't worry too much. Watch it a few times if you need to, just to kind of really make it sink in. But when it comes to supply and demand, the following is literally all you really need to think about. So literally all we're doing is we're just looking for where there are large imbalances between supply and demand that cause those huge shifts in the market. So we are trying to identify in the charts, where an overwhelming amount of demand entered the market to cause price to rapidly move to the upside. But then we'll look to buy when price returns to those areas of demand. And then we'll also look for where there was an overwhelming amount of supply that entered the market to cause prices to rapidly move to the downside. And we'll look to sell when price returns to those areas of supply. Now, when we combine this with everything that we already now know about market structure, so when we've identified the exact high value areas of the trend in which we want to position ourselves in, right? We've used multi-time frame analysis to wait for all of those time frames to sync to give us as much confirmation as possible. And then when we overlay that and overlap that with supply and demand, that then becomes another extremely powerful tool to help us with timing and refining our positions and our exits. And this is what we're going to dive really deep into over the next few lessons.